Maria Fuentes sat in her car outside the dealership for 11 minutes before she went back in. Her hands wouldn't stop shaking. Not from the cold. From the number on the screen behind the salesman's desk. 642. That's what showed up when he pulled her file. 642. And suddenly the interest rate on a used Honda jumped from something reasonable to something that made her stomach drop. She'd paid every bill on time for 3 years. Every single one. Rent, phone, the little credit card she used for gas. She thought that meant something. She thought discipline was supposed to protect you. It didn't. And what happened to Maria that afternoon in a fluorescent-lit dealership office has happened to almost everyone reading this. Maybe not with a car. Maybe with an apartment application that got quietly rejected. Maybe with a credit card that got denied for reasons nobody bothered to explain clearly. Maybe with a number that decided, without asking permission, how expensive the rest of your life would be. Here's what almost nobody tells you. The system that produces that number wasn't built to reward good behavior. It was built to measure profitability. And those two things sound similar. They are not the same thing at all. 3 companies control almost the entire credit reporting industry in the United States. Equifax, Experian, TransUnion. You didn't choose any of them. You never signed up. You never agreed to their terms of service. And yet they've been quietly building a file on you since the moment you took out your first loan. Maybe your first cell phone contract. Maybe even before you turned 18 if a parent added you as an authorized user. That file follows you everywhere. It decides your apartment. It decides your car. It decides your job in some states. Because employers can pull a modified version of it. It decides your insurance premium. It decides whether you get to marry someone without secretly resenting them for their spending habits. Because debt stress is one of the top reasons couples fight. And couples fight about debt because the whole system is engineered around debt in the first place. Nobody explained the rules to you. Not really. You were handed a credit card at 19, told to build credit, and left to figure out the rest through trial and error, usually the hard way. So let's actually look at what's happening behind the curtain. A perfect score, on the most common scale, sits at 850. Almost nobody has that. Most people hover somewhere in the 600s, worrying constantly about whether that number is good enough. And here's the part that should bother you. The formula that produces your score isn't public. FICO, the company behind the most widely used scoring model, treats its formula like a trade secret, guarded tighter than a lot of government documents. You are being graded constantly by a test you're not allowed to see. Think about that for a second. Every other kind of grading system in your life comes with some visibility. A teacher shows you what you got wrong. A doctor explains your test results. But the algorithm quietly, deciding your financial fate for the next 7 years, that stays locked in a vault in a building you'll never visit. What we do know is this. Payment history matters most. Then how much of your available credit you're using. Then the age of your accounts. Then the mix of credit types. Then new credit inquiries. Notice what's missing from that list. Your income isn't factored in directly. Your savings account balance isn't in there. Whether you're a genuinely responsible, careful, thoughtful person with your money doesn't matter to the formula at all. What matters is whether you're actively participating in the borrowing system. Whether you're generating activity that banks can profit from. This is where it gets uncomfortable. If you paid cash for everything your whole life and never once carried a credit card, you'd have a low score, sometimes no score at all. Not because you're irresponsible, because you never gave the system anything to measure. Meanwhile, someone who carries a balance every month, paying interest charges for years, someone who is quietly bleeding money to their bank every single billing cycle, can end up with a stronger score than the person who never owes anyone a cent. Read that again. Carrying debt and slowly paying interest on it can boost your score. Avoiding debt entirely can leave you invisible to the system, or worse, penalized for having what's called a thin file. Now ask yourself who benefits from that arrangement. It's not you. David Chin found this out the hard way back in 2019, when he tried to pay off his credit card in full every single month like his father taught him. His score barely moved for over a year. Then, out of frustration, he started carrying a small balance on purpose, just to see what would happen. Within 4 months, his score climbed almost 40 points. He was paying interest now, real money, disappearing into his bank's revenue every month. And the system rewarded him for it. That's not a glitch. That's the business model. Let's talk about what banks actually want from a customer, because it isn't what most people assume. The most profitable customer a bank can have isn't the one who pays off their balance every month. Banks call those people deadbeats internally, not because they're bad with money, because they don't generate interest revenue. The industry term itself tells you everything about how these institutions actually see responsible behavior. The most profitable customer is someone who carries a balance, month after month, making minimum payments, slowly, quietly transferring wealth from their own pocket into the bank's revenue statement. Someone who's disciplined enough to keep the account open and active, but not disciplined enough to escape the interest trap entirely. That's not an accident of design. That's the design. Credit card companies spend enormous amounts of money studying exactly how much debt a person can carry before they default completely, and they price their products to sit right at the edge of that line, close enough to maximize interest income, not so close that the person stops paying altogether and the debt becomes worthless. There's a term for this inside the industry: revolvers. That's what they call people who carry a balance month to month instead of paying it off. And revolvers are the golden customers. Entire departments exist to identify who's likely to become one. And entire marketing campaigns exist to nudge people toward that behavior, disguised as rewards programs. Cashback offers, buy now, worry later language stitched into every checkout page on the internet. Meanwhile, the people who pay in full every month, the ones actually being responsible with their money, generate almost nothing for the bank beyond the small percentage fee charged to merchants. They're tolerated, not celebrated. Tolerated. Now think back to Maria, sitting in that parking lot. Her mistake, if you can even call it that, was believing that responsible behavior alone would be enough. She didn't understand that the system wasn't measuring her character. It was measuring her utility to a lending institution she'd never met. And once you start understanding the system that way, other things start making sense too. Why does closing an old credit card hurt your score, even one you never use? Because the system wants that account open, generating a longer credit history, keeping the door open for future interest charges, even if you never walk back through it. Why does applying for too many cards at once tank your score temporarily? Not because you're suddenly less trustworthy, because it signals you might be desperate for credit, which makes lenders nervous about handing you more of it right when you might actually need it most. Why do medical debts people often didn't choose, debts that come from getting sick or getting hurt, hit credit scores just as hard as debts from reckless spending? Because the algorithm doesn't care about your story. It doesn't know you had a hospital bill because of an accident that wasn't your fault. It just sees an unpaid balance, and it reacts the same way it would to someone who maxed out a card buying things they couldn't afford. There's no room for context in a 3-digit number, only consequence. And the consequences compound in ways that feel almost designed to trap people who are already struggling. A lower score means higher interest rates. Higher interest rates mean bigger monthly payments. Bigger payments mean less room in the budget for emergencies. Less room for emergencies means one unexpected expense. A car repair, a medical bill, a reduced work schedule can push someone into missing a payment. Missing a payment drops the score further, and the cycle tightens again like a slow-closing fist. People with the least room to absorb financial shocks end up paying the most to borrow money. People with plenty of financial cushion, people who barely need credit in the first place, get offered the lowest rates and the best terms. The system doesn't level the playing field. It steepens it. This isn't conspiracy talk. This is published research from housing economists, from consumer protection researchers, from congressional testimony given by people who study exactly this pattern for a living. The Consumer Financial Protection Bureau has documented, repeatedly, how credit scoring can quietly reinforce financial inequality that already exists, especially along racial and geographic lines, because the data feeding these algorithms reflects decades of unequal access to banking in the first place. Zip codes with historically fewer bank branches produce thinner credit files. Thinner credit files produce lower scores. Regardless of how responsible the person actually is with the money they have, the algorithm doesn't know the difference between someone who never had access to a bank and someone who simply chose not to use one. It just sees an absence of data, and it punishes that absence the same way it punishes bad behavior. So when people ask why generational wealth gaps seem to persist, even among families who work just as hard, just as carefully, just as responsibly as anyone else, part of the answer is sitting quietly inside a three-digit number that most people never learn how to actually read. Now, here's where the story usually gets told wrong. Most people assume the solution is simply pay everything on time and you'll be fine eventually. And on some level, that's true. Payment history really is the single biggest factor. But it's not the whole story. And the industry benefits enormously from people believing it is. Because if you believe the system is purely a reflection of good behavior, you'll never question why a healthy, responsible adult with zero debt and steady savings can be scored lower than someone drowning in credit card interest. You'll never ask why closing a card you don't need is treated as a mistake. You'll never wonder why a medical emergency you didn't cause follows you around for years, like it was your fault. You'll just quietly accept the number, the way Maria did in that parking lot. And you'll adjust your entire financial life around pleasing an algorithm built by an industry that profits when you slip. So what actually works, once you understand what's really being measured? Keep old accounts open, even ones you rarely touch. Because age and history matter more than activity. Use a small percentage of your available credit instead of avoiding credit entirely. Because some engagement with the system, used carefully, keeps you visible to it. Pay in full when you can. But understand that the system was never built to celebrate that choice, only to tolerate it. And know going in that the game has rules written by the house for the house. And your job isn't to beat those rules emotionally. It's to understand them clearly enough that they stop controlling you by surprise. Maria eventually got that car. Not that day. She went home, spent 3 months paying down 2 smaller cards instead of one big one, kept her oldest account open even though she never used it anymore, and watched her score climb almost 80 points by spring. Not because she became a fundamentally different person. She was the same responsible woman she'd always been. She just learned to speak the language the system was actually using, instead of the language she assumed it was using. That's really the whole story here. Not that banks are cartoonishly evil, twirling mustaches in a back room somewhere, plotting your downfall. It's simpler and, honestly, colder than that. You're not the customer in this relationship. You're the product. Your financial behavior is the raw material a massive industry converts into revenue. And the score that follows you everywhere isn't a report card. It's a forecast, calculated to predict exactly how profitable you're likely to be over the next several years. Once you see it that way, you stop asking the system to reward your character. You start asking it exactly what it's actually measuring. And that, more than any single tip about paying bills on time, is what finally puts you back in control of a number that's been quietly running your life since before you even understood the rules of the game.